Let's take a look at Exxon Mobil. Now, this is a massive company, and what we're going to do is try to identify the intrinsic value of the company. So, what the stock price should be based on the expected future free cash flow. And this is what all major investors and analysts do to value a company. Warren Buffett does it. Of course, some equity analysts have a lot of information and a lot of knowledge, so their models are probably more in depth than mine, but this is mine and I'd love to show it to you. So first we need the market cap of Exxon, which is 188 billion. And now the stock price of 44.60. So they have 4.2 billion shares outstanding. And what we're going to do is look at the free cash flow, net income, and revenue to estimate the future free cash flow, because that's how you find out the value of a company. It's additional cash after operations. And then we're going to discount those future cash flows back to today's dollars. And once we do that, we'll have a value for the company. And then we'll divide that by 4.2 billion and see the stock price. And if we see the stock price is worth more than 44.60, maybe we'll buy it. Maybe it's a buy. But if it's less than 44.60, maybe we won't buy it, or we'll sell the shares we have. Now let's get started. And thanks for recommending this. All my videos are pretty much recommendations from people through my Facebook groups. So you can recommend a video by just leaving a comment, and I'll definitely do a video. And I appreciate that recommendation because it keeps me motivated to do more videos. And I can't think of every company in the world, so it helps to have people suggest. So when you buy a company, the most important part of the company is how much money you're going to make. And I think everybody would agree with that. You know, I'm sure you want to do something that helps the world, that makes you feel good. But at the end of the day, it's the money. So you would ask the person selling you the company is, how much money am I going to make? How much cash do you have after operating the business, after paying all your expenses? And they say, oh, I have $100,000. Then you may ask, well, how much do you pay yourself? Oh, I pay myself also $100,000. So you'd say, okay, the company's worth $200,000. It's pretty simple, right? But valuing a large entity like Exxon is much more complex than that. We need to look at a lot of things. And this is a basic cash flow model. And as you can see how variable the free cash flow is, it goes from 6 billion to 15 billion to 16 billion back down to 5 billion, because free cash flow is actual cash in and out of the company. So if on 2017, 2018, if Exxon had really large capex expenses, so let's look at cash flow from investing, and you can see in 2019 they had the biggest capex spend of 24 billion. So you'd have to look into their financials and identify, oh, that's CFO. Let's look at cash flow from investing. And you need to really dig into the numbers. The 10K has everything to find out why cash flow moves so much. For the purpose of this video, we're not going to go into that type of detail, but I'd be happy to if you are interested. So now we have the free cash flow estimate already done, because that's my model set up for that. We need to find a discount rate. And every company has their own discount rate. Now let's look at theirs. So the interest expense, the interest they pay on the debt, because how much money does it cost Exxon to borrow? Well, they take out debt by selling bonds, and we need to find an interest rate they pay on those bonds. So let's see the current liabilities, their current debt, which is debt due within 1 year, 20 billion. And non-current liabilities, which is a long-term debt, debt due beyond 1 year. And that's 25 billion. So you can see it's a really low interest rate. So they got great terms because this is a massive company, 1.83%. And I remember when I started getting into investing in high school, like 20 or so years ago, I remember Exxon. I was like, wow, this is the biggest company. I wonder if anybody will ever be bigger than Exxon. Well, now they're not even top 5. So let's look at the income statement, income before tax. It's still a massive company, just not nearly as big as these trillion-dollar companies like Microsoft, Apple, Amazon. And let's look at the income tax. So they pay 26% in taxes, which looks about right. So even though they pay 1.83% on their debt, it actually costs them 1.35% because they get a tax deduction on the interest payment. Just like when you have a mortgage, the interest is deducted on your taxes. So you don't pay 4%, even though that's what it says. You probably pay 3.25% after taxes. And the higher tax rate, the lower the interest you pay. So sometimes taxes aren't so bad. Now let's look at the beta, which is probably pretty good, 1.36. So that means it moves a little more than the market. It's a pretty low beta. And the cost of equity is 12.76%. So the cost of equity, we use the capital asset pricing model to figure that out, and it's all calculated in my spreadsheet. And it's always more, because when you sell part of your business, you're selling that appreciation of the business. And in Exxon's case, you're selling a valuable asset. And when you sell debt, you're just selling someone the right to receive an interest payment, a fixed interest payment, which is only maybe a few percent. In this case, not even 2%. So it's really not much of a financial benefit to buy a bond. Of course, there's a lot more risk when you buy stock, because what happens when a company goes bankrupt? The stockholders get nothing, and all the money goes to the debt holders, if there is any, the bondholders. So the weighted average cost of capital for Exxon is 10.56%. So that's how much it costs Exxon to get money, whether that money is from debt or equity. Now we have to discount the future cash flows by that amount. And we calculated the future free cash flow using their actual numbers. And you as the financial analyst can look at these numbers and say, well, that's interesting. I think the free cash flow for 2019 should actually be 10 billion, because I think the 5 billion they spent on this particular product, this machine, or this building is not likely to be a purchase in the future. Or whatever your analysis is, you can make your own decisions, and you could change these numbers however you like. I like to leave my model the way it is because that's how I built it, but every analyst has their own spin on things. And we calculated the free cash flow for 4 years, then the terminal value, which is the cash flow every year beyond 4 years. And we have to discount these numbers by the appropriate weighted average cost of capital, which is up here. And the discounted cash flows comes out to $145 billion. And when you divide that by 4.2 billion shares, we're saying the value of Exxon is $34.26, the intrinsic value. And the stock is actually trading at $44. So you'll notice if you watch more of my videos that these stable, strong blue chip companies that have been around a long time, my intrinsic value is usually pretty close to what they're trading at. But when you look at like these newer companies, especially these internet companies with tons of expenses and negative free cash flow, it's all over the place. We can't really calculate an intrinsic value. That's why Warren Buffett likes companies like Exxon or Coca-Cola. So looking at the historical, well, this is only, let's look at a longer period of time for Exxon stock, because this will be interesting to compare. Let me put it into my spreadsheet so it's all in the same spot. I should have done this before the video, but it doesn't matter. Okay, so now we have just 5 years of Exxon. So 44.60. So you can see before coronavirus, which is this big drop, it was trading at a pretty significant premium to intrinsic value. It was trading in 70s and 80s, and now it dropped to a better deal. It's still above intrinsic value, but why? Why would a stock trade so high above intrinsic value? People can figure this out. A lot of analysts have this information and provide a buy and sell on stocks. So why would people keep buying it above intrinsic value? The reason is because people think the future of the company will go higher, will be even better. So they buy stocks that are trading at a premium. And then the opposite can be true. You can see stocks trading at a discount, but people don't buy them because they just don't see the future. Like airlines or cruise lines, they just don't see the future of those companies being so great. Maybe in 10, 15 years it'll be okay, those companies, but in 5 years, not so great, and people don't want to wait a decade or two to get their money back. So let me know what you think. Obviously, this is just my point of view because it's my model, and everybody has their own opinion on things, as you know from reading YouTube comments. Let me know what you think of this model, and if you have any ideas, and if you want me to make a YouTube video of a different company, just let me know, and I'd be happy to do that. Thanks for watching.